Hi there, welcome to Kneppy Invest and welcome to another reaction video. It is April 25, 2025. The market is closed today, of course, because it is Anzac Day. And I was thinking, what can I do for today's video? And then I thought, I haven't done a reaction video for a while, maybe 2 weeks or so. And then I thought, yeah, the first reaction video I did was Motley article. And I thought, why not go back there? So I went to the Motley website, had a look at some of their articles they have released over the last 24 hours. And even though today is a public holiday, they're still releasing a fair bit of articles. And this one piqued my interest. From James Mickleborough, released at 8:03 a.m. on April 25. So no doubt James didn't write this this morning. He probably wrote this yesterday for release today. Anyway, 10 best shares to buy today in Australia. Not literally today because the market is closed. Analysis think these shares are among the best to buy now, which means these aren't the opinion of James Mickleborough, the writer of this article. These are the opinions of brokers for analysis from Bell Potter, Citi, etc. And I don't even think, if I remember correctly, James wrote any sort of commentary on these companies. All the commentary is from the broker. So, in a way, fairly good article from James because he didn't have to put much thought into it. Yes, didn't have to put much thought into it at all. And in a way, I am reacting to the sort of reaction from James to these recommendations from brokers. Anyway, interesting group of 10 companies. Now, for this exercise, what I've done is I've grouped these companies into two bins, high quality and low quality. This is something what I do. In fact, for most companies I know a little bit about, I already know where they fit on the quality spectrum. Are they a high quality company, low quality company? Sometimes a company could be in between. A lot of companies do transition from low to high quality or even the other way, and that transition can take a bit of time. So a few of these companies I would consider, I think about 5 companies high quality, 4 companies low quality, and there's one company I just don't know. It's sort of in between. And some of these high quality companies I would consider quasi high quality. And I do treat those sort of companies a little bit differently. So what I'm going to do for each of these 10 companies, and hopefully I'll go through it fairly quickly, is I'll tell you what I think in terms of their quality. And then I'll also go through some of their financial metrics. So we'll have a look at margins, return on equity, growth, revenue and earnings, any sort of dividend yield, payout, P ratio, and also the total return over the last 10 years. Now, 5 of these companies have listed within the last 10 years, and 5 of these companies have been listed for more than 10 years. I do like to start at a total return at the 10-year mark, but for those companies that have listed within the last 10 years, we'll just have a total return since they listed, and then we'll have a look at the chart. And you can tell a lot about a company, the quality of a company, just by their chart. Okay, so for some reason, I'm pretty sure this was in alphabetical order, but for some reason, Life360, maybe it's alphabetical order by the company name, not by the ticker code. Anyway, so the first company is Accent Group. So a very small bit of commentary, just telling what the company does. So there's actually not much substance to the commentary, and all that is mentioned here is that Bell Potter has a buy rating and $2.60 price target on its shares. Now, I'm not a big fan of price targets, that sort of thing. In fact, very rarely do I look at any sort of recommendations from brokers. I like to form my own opinion. And I think that's very powerful when you can form your own opinion on a company. Okay, Accent Group, this is one of those companies where I probably consider more high than low quality, but I'd probably also say it's a quasi-high quality company. Now, the way I deal with quasi-high quality companies, it's not the sort of company I'll probably want to own for the long term, but I do look at valuation. And when it comes to high quality companies, that's the most important thing for me. The valuation of the company right now. Is there really good value? And if there's really good value, that could be a nice little buy. Now, because I would consider Accent to be a quasi-high quality company, and if I saw some value now, I might take a position, regardless, whichever one's the right one, regardless of the chart. So even if the share price is in a downtrend, I still might take a position. And that is completely different than low quality companies. It's all based off the chart. So a good way to talk about this is When it comes to high quality companies, it's all about valuation. When it comes to low quality companies, it's all about technicals, all about sentiment. Anyway, so Accent Group, I'd probably focus on the chart and just see if there's any valuation. So the reason I'm saying chart is I'm looking to see where it stands in relation to 200-week moving average and then valuation. So P ratio is very important there. Otherwise, I probably wouldn't own Accent Group for the long term, and you'll understand why when we have a look at the chart. Now, when you have a look at some of the financial metrics, it's all good. So nice gross margins, 56%. Operating margins a little bit lower than what I'd want, 9%. Return equity, 14.5, exactly what you want. Growth in revenue and earnings between about 10 and 20%. In fact, I do have it up right here. So this is via FinChat. And if you have a look at the revenue, when I'm talking about revenue and earnings growth, we're looking at the last 3 years, 5 years, and 10 years. And this company has pretty nice revenue and earnings growth over that period of time. They also have a pretty nice dividend, 6.1% dividend yield and a payout ratio of 88%. That's a little bit higher than what I would like. So most of their profit is going to the shareholders or back to the shareholders as a dividend. Total return over the last 10 years has been 15.2%. And P ratio right now is 15.6, which is not excessively low. Now, if I saw Accent Group getting to a P ratio less than 10, I would become a little bit more interested. So if we have a look at, say, the P ratio, this is the gross margins. I just had a look at the gross margins before I started recording. So if we have a look at the P ratio over the last 10 years, where does 15 stand? Now, there's been a couple of times in the past when the P ratio was about 10. So it's on about middle of 2023 during COVID-19 and also back in the middle of 2017. P ratio of this company got to 10. So that's the sort of P ratio I'd be looking at. And if I did see that with Accent Group, maybe that's a nice little buy for at least a period of time until the share price and the valuation increases back up to its normal levels. Now, when it comes to the total return, I should also mention this. Now, just because the total return of a company might be really high over the last 10 years doesn't mean it's a buy. In fact, what would be more attractive for a high-quality company is a total return to be quite low. That would mean that maybe the company is attractive on the valuation levels. And we do have one company where there has been a negative 10-year total return. And that's that one company, I'm not sure where it fits on the quality spectrum. Okay, so Accent Group, and the last thing about Accent Group is the chart. So this is the weekly chart for Accent Group, going back to 2017. I'm not sure why it goes back to 2000. I'm pretty sure this was, maybe they changed the name or something. I forget. Anyway, so if you have a look at these particular long-term charts, about 7 years, 8 years now, and you can see the 200-week moving average is this red line in the middle. And I would say that you can see over time the share price has been increasing, but a fair bit of volatility in there as well. So you do see the sentiment of this company shift from negative to positive, negative, positive. But over time, the share price has been increasing. So where does the share price fit right now in relation to the 200-week moving average? It's below it. So if you do believe in a reversion to the mean, we can expect eventually the share price to get well above the 200-week moving average, which means the share price will be higher than it is right now. So if you do consider this company to be high quality, even though the P ratio of 15 is not quite as low as what you might expect, with the share price below the 200-week moving average, this might be a nice buy. A nice buy for a portfolio that you want to own for the long term. Okay, now on to the second company, Cochlear. This is one where I've always considered high quality. And then as I had a closer look at this company a while ago, I thought, is it really high quality based off the lack? When I say lack, it is growing, but there is a bit of a lack of growth. So nice gross margins, 75%, operating margins. That's why I say gross up, because I've just got written there gross and op. Anyway, operating margins 23%, return equity 17%, so that's nice. So we want at least above 10 for return to equity. Growth in earnings. This is where it becomes interesting for Cochlear. By the way, what did the commentary say? Nothing much. Yeah, price target for Citi of $300. Anyway, so let's have a look at, go back here. We'll just have a look at the growth. So So last 5 years, revenue has been growing 9.3% and earnings at 1.3%, but generally it's just above 10%. But the reason I'm focusing on growth is just because of the P/E ratio. So P/E ratio is at 46, which does seem to be a fairly high for a company that hasn't grown all that much. So either the market is expecting some really good growth moving forward, or there is a massive premium for shares in this company. I'm not sure if I'm willing to pay that sort of premium. What else? Total return over the last 10 years at 12.9% per year, which I did expect that to be a little bit higher. A dividend yield at 1.6%. And the dividend payout ratio, a little bit higher than what I would have assumed for this company at 75%. The next thing I'm just going to have a look at quickly is the P/E ratio. And I've always have thought this company has been expensive. So this is the P/E ratio of, that's the problem. So what I'm going to do is, instead of looking at the graph, just have a look at the end of financial year numbers. And typically, the P/E ratio is above 40. Now, back in 2015 and 16, P/E ratio was between 30 and 40. But typically, the P/E ratio of this company is above 40. And based off the growth, or I wouldn't say lack of growth in revenue, I think there is, or has always been, a bit of a premium for this company. Okay, so in fact, what you could do is have a look at EV to free cash flow, just see if there's something else here. One of the problems with P/E ratio is sometimes there's going to be a one-off. Even with the EV to free cash flow, there's a one-off. So whenever there's a one-off, it can really affect like the P/E ratio for a company. What about the free cash flow yield? Yes, even then, yeah, there's this massive dip in 2020. Now, if you do have a look at the free cash flow yield, it's fairly low compared to historical levels. So maybe not all that good value in Cochlear at these levels based off the free cash flow. Okay, so let's turn our attention to the chart for Cochlear. And I think you'll see a high quality company. So I would probably consider Cochlear to be a high quality company. So really it's just valuation. Now, the one thing I'd probably like to see is a little bit higher growth, a little bit higher revenue growth and earnings growth to justify the current valuation or the current P/E ratio. But this is definitely the chart of a high quality company. I do know back in 2013, 14, sometime in the early 2010s, there was a little bit of problem with this company. I can't remember what. Wasn't really following the company at that point. But since about 2014, so over the last 10 years, share price typically has been above the 200-week moving average. And right now, it's right on the 200-week moving average. So just based off that signal, maybe this is a buy. Maybe Cochlear is a buy. But I would like to see a little bit more growth, and I would like to see the P ratio to be a little bit lower. Okay, now on to Domino's Pizza. This is the one where I'm going, A few years ago, I probably would have said this was a high-quality company, at least a high-quality company, maybe quasi-high-quality company. Now I'm not so sure. I think that's because of what management have done. They sort of went a little bit aggressive with their store rollouts, particularly in Japan, and that was a mistake. And now they've gone the other way. They're now a little bit more conservative, which might be the right thing to do. Goldman Sachs believes the tide is turning. Now, if the tide is turning, this could be interesting company or a stock. And recently put out a buy rating and $37.30 price target. So let's have a quick look at Domino's Pizza. We'll go to this. In fact, we'll start off with the P/E ratio, I suppose, since we're already there. Now, right there, the P/E ratio is fairly high right now. Because of the problems the company has had, the P/E ratio is like 185. Now, historically, the P/E ratio of this company has been fairly high, consistently above 30. And one of the reasons behind that was the very impressive growth. So if we just have a look at the revenue growth of this company up until the last few years, really strong revenue growth from like 2015 all the way through to 2022. The last few years, the revenue has stopped growing. So that could be a concern, or this could be just a little period where this company is not growing and then they go back to growth over the next few years. Or maybe this is the top. Maybe this is it for Domino's Pizza and they've hit a bit of a roadblock when it comes to growth. But anyway, if we have a look at some of their metrics, margins, gross margins 32%, operating margins 7%. I would expect if the tide is turning that the operating margins will start increasing. Return on equity, 26%. So that's pretty nice. That's sort of actually really good. I put down when you have a look at growth, so very anemic growth when it comes to revenue, but 13.2% over the last 10 years. But over the last 3 and 5 years, revenue has really stopped growing, as we just saw. But earnings per share growth has been negative over the last 10 years. In fact, over the last 3 years, at negative 56.1%. So that's a little bit concerning that the earnings right now is lower than it was 10 years ago. And in fact, the total return of Domino's Pizza is negative at negative 1.4%. Now, if this was a high quality company, that could be a good thing. That could be a good thing. So maybe the market is, maybe there's some value in this company. So the way I look at total returns is if it's a high quality company and the total returns over the last 10 years has been quite anemic, that could be a good sign there might be value. Sort of like Microsoft in 2013. I'm not sure we were able to see that. Yeah, in fact, we might be able to see that. Microsoft, we should be able to see it. If we go to max. I'm going to put my face up there. So if we go to about here, oops, I got to move this to about there. So the total return of Microsoft over, I think even a longer period than that, I think it was like share price started to turn up 2013. So, but for a 12-year period, Microsoft gave their shareholders a return of 0% from June 2000 to November 2012. 0%. And since then, the total returns have been roughly 23.7% per year. So just because the total returns are really low over a period of time does not necessarily mean it's a bad investment. In fact, it could mean the complete opposite. It could mean that with the company has seen a period of multiple contraction and the company is much more attractive at those levels. So just because the Domino's Pizza's total return over the last 10 years is negative is not necessarily a bad thing. But it would be a good thing if I would consider or did consider Domino's Pizza to be a high quality company. And I'm not sure I am just there yet. They do have a dividend yield of 4%. 4%, and the dividend payout ratio is like 777%. Is that right? Well, I've got to change the company. I did write 777%, and yeah, 777.5%. So I probably wouldn't focus on that just yet. Now onto the chart. Now onto the important chart. Now the chart for Domino's Pizza, I would not consider in the slightest sense this to be the chart of a high quality company. Because maybe for a period of time, yes, but the share price has been below the 200-week moving average since the start of 2022. So the last 3 years, the share price just keeps on falling. Share price at about a 10, 11-year low. But if things are turning around for this company, maybe this is a nice little buy. So maybe I'm being a little bit harsh on Domino's, but yeah, I'm not sure if I'm there just yet when it comes to this company as a long-term buy. But if we do get a sign, if we do see a sign that things are turning, so financial signs that things are turning around, this could be a nice little buy, nice cheap buy. And yeah, that's what I'm going to say. Next one is HMC Capital. I don't know much about this company. I'm pretty sure HMC Capital is an asset manager. Let's see what they say. Yeah, asset manager. Yeah, real estate, infrastructure, data centers, and credit. Interesting, Goldman Sachs believes its shares could double in value from current levels. Interesting enough, this asset manager is flying under the radar. I don't know if I agree with that. Now, the share price has dropped a lot recently, the last few months. In fact, it's halved. And before that, yeah, this was not flying under the radar. There was a lot of interest in this company. In fact, I believe they did spin out a DigiCo infrastructure REIT, I think a data center REIT or something like that. But I don't know a lot about this company. HMC listed in October 2019. So it's been around for just over 5 years. And you don't get much, I don't really see much It's hard to do analysis of this company because market cap is 1.93 billion, gross margins 100%, operating margins 50.9%, return equity 3.2%, return invested capital 12%, revenue growth over the last 5 years 27.4%, earnings per share 16.7%. So nice growth. That's exactly what we like to see. Dividend yield 1.2% and payout ratio 20.7%. Also says the P ratio is at 7.7. Now, I just need a little bit more history when it comes to this company because it was only founded in 2009 and listed in 2019. So if that P ratio of 7.7 is true, with that sort of growth in revenue and earnings, this company could be attractive, although the return on equity is a bit meager. What's the other metrics I have for this one? It has a 6.5% return since it listed. And the main reason behind that is the share price has plummeted, has completely cratered over the last few months. So there is a chance that the market is overreacting on the downside. Now, one of the reasons why I think the share price ran up a fair bit and in fact, if you do have a look at the weekly chart for this one, yeah, the share price over about a year period went from $3.50 up to $13. And one of the reasons why the share price did that was just the data center thematic. And this company was riding on that wave until that wave started to slow down, sort of peter out. And the share price, since that wave started to peter out, has completely collapsed. In fact, there was a couple of really big down days in the middle of December. And that was sort of the trend killer. In fact, let's have a look at the 2,500-day moving averages. Yeah, that was a trend killer event. And the share price has decreased significantly since then. When they did release their results in February, the share price did pop up about 10%. But yeah, that was not a good sign because the share price has dropped significantly since then. In fact, the share price is more than halved. So there is a chance that the market is reacting to this one because I do believe there is still that data center thematic. I do think that data centers will thrive over the next 5 to 10 years. But a lot of these sort of companies, you'll see the sentiment shift from fairly positive to fairly negative. So the question becomes, where is the bottom? Now, I would probably not consider HMC Capital to be high quality. I don't have enough data for this one. I want a little bit more data, only 5 years of history. And just, I think sentiment is driving the share price of this company up and down, particularly if you look at the PE ratio and that sort of thing. So I believe sentiment is the main driving force of this company right now. And that would be true for low-quality companies. Sentiment is the main driving force. Anyway, so at this point in time, yeah, HMC Capital, this could be near the bottom. This could be a nice buying opportunity. I'd probably like to see some bigger volume coming in, which would be a good sign that fund managers are seeing the same sort of thing. But I would say maybe during this down period over the last few months, along the way, there's been people saying, oh, this company is looking much better value. And then share price keeps on dropping. We just don't know how long that share price will drop. I don't know if they've got holiday here. Thank you. Anyway, so that's HMC Capital. Yeah, that's one of the companies that I would put in low quality spectrum or low quality bin. Now to another company that I would not consider high quality. That's Life360. Life360, Bell Potter apparently is bullish on its outlook and has a buy rating. $28 is a price target. This is a company I have been trading because it is not high quality. One of the reasons I would not consider Life360 to be high quality just yet, it has a potential, is because it's either not profitable or it's barely profitable. It's growing nicely, growing really nicely, but we need to see profitability. I want to see that it can stay in profitability. There is some concerns about competition, but those are some concerns I have read in some stuff before. Gross margins 75%, operating margins 2%. That's because, negative 2%, in fact. So nice gross margins, but lack of profitability, operating margins are negative. Return equity, well, a lot of this is negative, so we won't focus on that. So there's no dividend, no P ratio, and the growth in revenue has been very attractive. So this company listed in May 2019, so we only have 5 years of history, and that 5 years of history, revenue has grown at 44.5% per year, which is really good growth. The other thing I should mention, the market cap of this company is $4.7 billion. $4.7 billion. So a lot of potential has already been priced into this company. So we need to see this company become profitable and then increase their profitability at a great rate, at a fantastic rate. The other thing I should mention here is Life360 has given their shareholders a 25.5% return over the last, well, since they listed on the ASX in May 2019. And one of the reasons behind that, share price went on a really nice run recently. Okay, so I don't think we need to look at anything else here. There's no P/E ratio history to look at, that sort of thing. So what I'm going to do now is just focus on the chart. So this is definitely one where I will trade around, but I won't own any shares for the long term. Now, the share price got as low as $16 recently, has rallied back up to $20. But there was a nice, they released something really good on the 1st of March, 2024. Share price on that day rose 38.48%. That was a breakout. That's when I just started trading it. And then I bought some more shares somewhere on the way. And you can just see how the share price, this is a daily chart, how it's just been turning around. Now, this is because of negative sentiment in the overall market. Maybe that negative sentiment in the overall market is starting to turn more positive. We just don't know at this point in time. So this one is as I'm just trading the chart. That's all I'm doing. Just trading the chart. And at this point in time, the uptrend has come to an end. If you do have a look at the weekly chart, by the way, we just don't have enough data just yet. But since we do start to see the 200-week moving average, start of 2023, it's been well above that. It's been well above it. So hasn't been below that unless you call the first 6 or 7 weeks as being below it. But yeah. Anyway, so we did see the share price try to pull back to the 200-week moving average, but no cigar there. Now, this is the sort of company where I do follow any sort of release the company has. And the main reason behind that is because that impressive revenue growth. But I would not consider Life360 to be high quality just yet. It definitely has a potential, but just not yet. Same with the next company, NextDC. This is all about data centers, not profitable. So that's my main concern or complaint about NextDC. If you believe the rise of AI, cloud computing, and digital infrastructure, NextDC is an ASX share to consider. Its data centers are critical enablers of everything from streaming to fintech with strong demand, etc., etc. And NextDC is built for the future. Nothing wrong with that. I don't have any complaints about that particular paragraph. Team at Morgan's is positive, and the stock has an A rating and 1880 price target. So just like 360, this company is not profitable. In fact, if you have a look at some of their metrics, another company with a very high market cap, 10 billion market cap, or 7.12 billion. I suppose the share price has pulled back a fair bit, yeah. Now, this company is just building out the infrastructure. They're continually building out the infrastructure. And I've been following this company for 10 years now, about 10 years. And you just see them just building out the infrastructure. So that's why they're not profitable. They're moving into Asia. So there is potential, a lot of potential for this company in terms of infrastructure. But when eventually this becomes, I suppose, more profitable, maybe that growth story has come to an end. Maybe, I don't know. Anyway, so there's no point really talk about their financial metrics because the revenue has been growing nicely between about 15-25% per year. And the company has given their shareholders a return of 16.8% per year over the last 10 years. So it's pretty nice. So let's just have a look at the chart for NextDC. I have a feeling this could be, this could have a signature of a high quality company. And yeah, it does. And what I'm looking at here, and I think one of the reasons behind this is that there's been a lot of interest in this company, even though it's not profitable, just building out its infrastructure around the world, and that eventually it's going to be just producing cash flow like it's coming out of its, at the end of each person. Anyway, so if you do have a look at this chart, it is interesting. So buy high quality companies, the share price goes below the 200-week moving average. I'm not sure if I can consider NextDC to be a high quality company, but it has the technical signature of a high quality company. Share price has been consistently above the 200-week moving average, and when it falls below it, which has only happened once, now twice, that's the time to buy. Last time it happened was during late 2022. Remember, we had that double bottom in the market, June 2022, October 2022. That was a top time to be interested in NextDC. Share price got as low as $8. Right now, it's $11.12. Didn't realize it was so low. And just like HMC, we have seen share price just pull back significantly. And this is just lack of I wouldn't say lack of sentiment. This is more of sentiment in data centers going from positive to negative, and I think the market is overreacting. So I am, even though it's not profitable, even though it's not high quality, I think this is more interesting. I think NextDC is actually really interesting at these levels. Okay, now onto a company I would consider high quality without a doubt, and that's Resmed. In fact, I would consider this company either the highest quality or the second highest quality on this list. So Goldman Sachs it just says Goldman Sachs is one of them. It's continued to grow strongly despite concerns around weight loss, wonder drugs, and analysts are confident this trend will continue. Goldman Sachs is one of them, has conviction, buy rating, and 46.90 price target. Now, interesting enough, Resmed did release their quarterly results on Thursday. They were good. Share price up 9% on the ASX. They're also listed on the New York Stock Exchange, and the share price up 10.14%. Okay, so that's pretty good. Pretty good for Resmed. Now, I was not a shareholder of this company until that Ozempic fear. Remember that Ozempic fear a few years ago when the share price of Resmed just plunged because the market was completely overreacting? That was a great opportunity, one of the best opportunities we've seen to buy a high-quality company like Resmed. I should have bought more. In hindsight, I should have bought more. But this has all the makings of a high-quality company. Just have a look at the metrics. Gross margin is 59%, operating margin is 32%, return equity at 22.8%, very nice. Even return on invested capital is at 17.7%. Have a look at the growth in revenue and earnings per share, all above 10%. In fact, earnings per share growth over the last 5 years is 20.4%. Probably my one concern about gross margins, they were dropping, now they're rising. So last 2 years, they've been rising. That's good. Dividend yield, who cares about a dividend yield? This is not the sort of company you want to own just because of a dividend. In fact, in my opinion, you just don't own any company because of a dividend unless you are income seeker. If you need the income, there's no reason to really focus on dividend yield. So dividend yield 1%, payout ratio 5%. So they're putting most of their profit back into growing the company, exactly what I like to see. And returned over the last 10 years is only 13.7%. I probably would have expected that to be a little bit higher, and the P ratio is at 24. So let's have a look at the P ratio of this company. So even though share price has rallied really nicely since those lows with their Ozempic fear, by the way, this is total revenues, exactly what you want to see. This is a great example of a high quality company. Just looking at the revenue, growing every single year. Yes, and we'll just put the gross margins here as well. So gross margins did drop between 2020 and 2023, but the last few years they've risen. That's really good. And one of the reasons why the share price rallied on Thursday was because gross margins expanded really nicely. What I was going to look at, P ratio, that's right. PE ratio, 24 does sound low. The other thing I should mention is, so P ratio is 26.5. I think this is updated more regularly than the overview, I'm assuming, because the share price just popped up. One thing I should also mention, looking at these metrics, this was a really quick look at metrics of all these companies. Some of these metrics could be wrong, or they could be different from other sites. So have a look at some of these metrics. So if you do like Resmed and you think 24 P ratio is fairly low for this type of company, have a look at some other sites. Maybe 24 is wrong. But and if you have a look at the last 10 years, not prior to 2018. So prior to 2018, the P ratio was actually below about 30. But since then, if you can buy this company at a P ratio between 20 and 25, you've done good, because it hasn't been below that all that often. So even though the share price of Resmed has rallied nicely, in fact, let's go back to the chart. Again, the weekly chart. Share price fell a fair bit in September 2023. I did not time the bottom. You don't have to time the bottom at all. But I saw an opportunity to buy some shares in Resmed. Share price then rallied back up to its all-time highs back in January. And then we saw share price fall, and then nice little update, and the share price has rallied. So even though share price is near the all-time highs, P ratio is still fairly low. So there is still some attractiveness in terms of valuation for this company. Now, sometimes I like to look at what TradingView says the P ratio is. Yeah, 25.9. So is there any reason to think they're wrong? Another one you can do is have a look at ComSec. Just have a look at ComSec. ComSec will have a P ratio. And if this is like 25.8, P ratio is 33.45. So there is a little bit of difference there. Yeah, so that could be, if I was just focusing on ComSec's P ratio, I might think that 33.45 is fair for this type of company. Anyway, this does have the qualities. This chart is a great example of a high quality company's chart. Just go back through time. Share price consistently above the 200 week moving average. On occasion, it does fall below it. But if we go back to, say, 15 years ago, I would think at that point there would be maybe an argument this was not a high-quality company yet. So it did struggle to remain above the 200-week moving average on occasion. But really, since 2012, it has been consistently above the 200-week moving average, apart from that Zempic fear. Again, that was a great buying opportunity. And this is why. Well, for some reason, the market sold off. Market panicked because of fear, that sort of thing. And the share price hit a low of about $21. And the share price almost doubled from then when those fears died away. Okay, so Resmed. Yes, I would put this as a high-quality company. And it could be cheap. If the P ratio is really 25 or so, that could be good value and a nice quality update from the company. Okay, next company I want to look at is Temple & Webster. Let's go back to this one. Temple & Webster. Okay, what do they say here? Online furniture, yeah. Strong brand, low inventory model, and growing offering continues to take market share in a fragmented industry, which is shifting online. I don't understand why people would buy furniture online. For me, if I want to buy like a couch or a bed, you want to go and try it out first. So that's interesting. I didn't think this company would survive. Citi currently rates it as a buy with a $21.10 price target. This is another company I've been trading. And the reason I've been trading this and don't own it for the long term is because it's not a high-quality company. I consider this to be still a low-quality company because it has to prove itself to me over longer term. Barely profitable. In fact, the P ratio of this company is fairly large. So let's have a look at high. P ratio is high. So let's just have a look at some of the metrics of this company. So gross margin is 34%, operating margin 2.4%. So it has room for that to grow. So there could be not a chance or possibility that the profits of this company could like double, triple, quadruple in 1 year. I can actually see that happening. Return equity at 10.7. I would expect return equity, return invested capital to actually grow from here. If it doesn't, that would be a concerning sign. The growth rate all over the place. So revenue over the last 3 years, only 11.7%. Over the last 10 years, 39.1%. By the way, this company listed on the ASX in December 2015, so almost 10 years ago. Earnings over the last 10 years got nothing there. And over the last 3 years, actually at negative 8.6%, which is interesting. No dividends, of course. P ratio apparently is 316.5. Because the profits are fairly low. So there's no point looking at the P ratio and wondering if this is cheap based off that. Look, the revenue is growing. If you have a look at the revenue growth, yeah, growing, but the big growth in revenue for this company was during COVID-19. Before that, it was starting to grow, but I think COVID-19 really helped this company, and revenue growth has sort of flattened out since then. And I just do wonder if we do go into a weak economy over the next year or so, how much this company would be affected. So I wouldn't consider this company high quality just yet. However, in saying that, since it listed, the total return for shareholders has been 37% per year. So it's a pretty nice return, but I don't expect you'd see that over the next 10 years. By the way, the company has a market cap of $2 billion, which does seem a little bit high for me. Okay, let's have a look at the chart for Temple & Webster, because I don't consider this company to be high quality. I just trade it. That's all I do. If you have a look at the weekly chart, and we can get rid of that. So I was trading it. I'm no longer trading it anymore. You can see over time, since they listed, the share price has increased a fair bit. In fact, just after they listed, there was concerns about this company. That's why the share price dropped significantly from listing, went from like $1 down to 15 cents. And I still remember the breakout in the share price of this company in sort of towards August 2017. I still remember that going, this could be a nice little buy at 20 cents. It was a nice little buy at 20 cents. And then, of course, they experienced being a little bit unfair because you can actually see before COVID-19, the share price was rallying really nice. And then it can just continue to rally after COVID-19 panic. And share price did get to its highs. A lot of volatility here. And I would also say this sort of volatility you won't see in a higher quality company. Share price went from $15 back down to $3 in a short period of time. The whole reason you see that sort of volatility is because it's all about sentiment, and it's really hard to do a valuation of these type of companies. If you do like a DCF, you could get a range of different values. You could get a range of values from $5 to $200 or something like that. So I would never do a DCF for this type of company because it's just impossible. So I think one of the reasons you might invest in this company for the long term, if you have faith in the management, or maybe not faith, if you believe in the management, I suppose that's the same sort of thing, and also you think the business model is going to be successful, and yeah, this sort of online furniture model is, it's going to be highly successful. Now, in saying that, share price is well above the 200-week moving average, and it was back in 2020, 2021. Then the share price pulled back. So I would only trade this at this point in time. That's just me. Because again, I wouldn't consider it high quality just yet. Universal Store Holdings. This is the second retailer. I don't know you consider Domino's to be a retailer. So we have Accent Group and Universal Stores. Based off its metrics, I actually did compare the metrics of these two companies. So I don't know who wrote this, if Milborough wrote this, but one of the most exciting ASX retail shares companies, I'll put companies there, not shares. Universal Store is rolling out new stores and growing its brand portfolio. Bell Potter. The reason I said Bell Potter is because I saw the fan there and I just sort of translated the F to the start of Potter. So I would have said Bell Potter is a pan. That's what I would have said. So Bell Potter is a fan and rated a buy with a 10.50 price target. Now, they also mentioned expanding margins and generous dividends. That's not for me a sign, although I'm having a look here. Ooh, geez. Okay. If I compare this to Accent Group, if I had to choose one, I'd probably choose, regardless of valuation, I'd probably choose Universal Stores, but that's what the market thinks as well, just based off their P/E ratio. So let's have a look at Universal Stores right now. If I can find it here, there it is. Is it Universal Store? No, there's no S there, just Universal Store. Okay, so market cap is 586. I can't remember what Accent Group's market cap, like maybe $1 billion. So gross margins, operating margins, higher than Accent Group. A return on equity at 20.1. It's very nice. So it's higher than Accent Group. Growth. This company listed on the ASX in November 2020. So we only have about 4.5 years of history. So that is one little negative thing about Universal Stores. We don't have a lot of history here, but revenue has been growing at 14.5% over the last 5 years. We don't have earnings per share growth. Over the last 3 years, only 1.3%. And what else do we have here? Dividend yield at 5.3%. Says a payout ratio is 125.8%. I'd like to research a little bit more. You don't want to see a dividend payout ratio more than 100%. In fact, I don't like to see a dividend payout ratio more than, say, 50%, preferably less than 25%, if I'm honest with you. I prefer a company to reinvest their profits back into the company. That's just me. And since they listed in November 2020, when a lot of other companies listed on the ASX, total returns for shareholders 17.8% per year. So not bad. By the way, total return is share price plus dividends. So the article mentioned expanding margins. Let's confirm that. Let's confirm expanding margins. So we have a look at gross margin. Oh, yep, that's gross margins are expanding. Absolutely true. What about operating margins? I assume this is expanding as well. Oh, not. Yeah, it sort of did. The operating margins were the highest in 2021, and they've pulled back a little bit, but they started to expand again slightly. Okay, so Universal Store. I suppose we could have a look at the P/E ratio, even though it's only been around for 5 years. Let's have a look. See, so 20. What's it? P ratio is at 22.9. Accent Group's at 15.6. So if Universal Store was at 15.6, I probably would be interested in this. By the way, the reason I say that is P ratio of Universal Store got as low as 8 in 2023. Ooh, that would have been attractive. Why didn't I buy Universal Store back then? Probably not enough history to really think about whether it's high quality or not. And I think I've changed, and I think maybe the market has changed as well. In fact, the P ratio is at record highs almost. Okay, so let's have a little chart for Universal Store. This is another one where I'd probably say it's high quality, but quasi-high quality, not high quality in the same realm as Resmed and also the last company we're going to look at. But I think this is definitely the sort of company that if you held in your portfolio for the long term, you probably do fairly well. Now, in saying that, look at the chart, the weekly chart, all over the place. Well, we can see the share price dropped to 250 back in 2023. Yeah, definitely. That was a ton of buy. Geez. But definitely, this is not the sort of chart you want to see for high quality company. So, but I do think, just based off its metrics, you could say high quality or quasi high quality has the makings of a high quality company. And if you do see the share price below the 200-week moving average, and we've just started to see the 200-week moving average, it's above it right now. If you do see it below that line, maybe a buy, maybe a buy. And finally, Wisetech, a bit of a controversial company. This is a company I do own. I would consider this a high quality company on the ASX. A few reasons behind it. Let's have a look to see what Goldman Sachs thinks. Hit by governance controversy, yep, tech sector weakness. Business remains a global leader in logistics software, absolutely right. The company is built for resilience. This could make it a golden opportunity to buy a premium name at a relative discount. We'll have a look at that. Goldman Sachs thinks so. Buy rating $128 price target. So let's have a look at Wisetech. Now, there's little doubt. Well, I suppose there could be a bit of a debate here whether this is a high quality company. So someone might say, well, the founder and CEO may not be the greatest guy, so not a high quality company. Gross margin is 85%. Operating margin is almost 40%. That's a really nice start. I actually did expect the return on equity to be a little bit higher, 13%. So there is a chance you could see expansion in return on equity, which would make this company even more attractive. If we have a look at the growth in revenue and earnings, really good there. So we're looking at revenue growth being 33.8% over the last 10 years, even the last 3 years at 27.1%. So solid growth. No, solid is the wrong word there. Spectacular growth in revenue and earnings per share growing between about 26 and 32% over the last 3 to 5 or 10 years. You don't buy this company for the dividend yield 0.4%, and the payout ratio is 29.6%, exactly where I want to see it. So that actually gets a massive tick for me. Don't care about it. I'm not buying this. I don't hold this for the dividend yield. I own this for the massive growth potential. Okay, so P ratio is at 89, which seems really high. So let's have a look. Now, based off the growth, and by the way, the return for this company, since it listed on the ASX in April 2016, is 41.2%. That's spectacular returns. I just wish I discovered this company a little bit sooner. So let's have a look. And by the way, let's have a look at some of these fantastic growths. So let's have a look at revenue. Look at that revenue growth. By the way, that's the last 12 months. So you can just forget that that's last one. It's not a last year, last 12 months. So spectacular growth in revenue. The other thing I like to see is gross margins. Has gross margins been going up? Sort of, yep, going up. Operating margins, I would assume this to be possibly going up as well. Yep. So I would like to see gross or the operating margins to be a little bit higher, but that's okay. I'm being a little bit greedy there. The other thing I like to look at is we go to ratios, and we'll have a look at P ratio in a second. I was going to have a look at return on equity. I'm doing this fairly quickly. Return on equity typically is between 10 and 20%. We have seen it below 10% once. That was in 2019, so that's okay. I just want to see if there is a chance that return on equity might expand. I'd like to see return on equity expanding. That's one thing I'd like to see right now. Now on to P ratio. This is the exciting one. Is there some value in this company at current levels just based off its P ratio? Wait, that's the wrong one. Oh, I got rid of the wrong metric there. P ratio. Now, I'm just going to get rid of that little spike in 2016. So just have a look at P ratio of this company since about 2017. So it's been as high as 225. And it's been as low as about 40. So about 40, about 40 during the COVID-19 financial panic. And it's about 80 now, or 95.87 according to this. So on occasion, it does fall to about 70. So it fell about 70 in June 2022. I don't know. This is the one where I would consider this company to be high quality, definitely. But I think it's the CEO and founder. Is he still the CEO? I can't remember. Definitely the founder. Anyway, so this is the 200-week moving average. Definite signals or definite characteristics of a high-quality company. And funnily enough, if you have a look at the 200-week moving average, the share price did fall below the 200-week moving average during the COVID-19 financial panic, has been above it until a few weeks ago. It did drop below the 200-week moving average, probably in April the 7th, and has rebounded really nicely since then. Look at that rebound. There it is. Yes, so that was a nice little buy. Share price got as low as $68. Now it's $86.58. So this is one where if I do see the share price fall quite a bit further from here, I will add to my position in Wisetech. So I would consider Wisetech to be among the highest quality companies in this list, if not the highest quality. Resmed would be along that. Also, so Wisetech, highest quality, Resmed, highest quality. So for both those companies, where's the valuation? Is those companies or are those companies good value at current levels? The next three companies on the quality spectrum, I put Accent Group, Universal Brands Universal Store, and Cochlear. If Cochlear P ratio, if that was much lower than it was, if Cochlear was like 20, I'd be really interested in that. I would put that probably above the other two. And Accent Group and Universal Store, I would more than likely trade those. If I see some really good value, I'd probably buy. And then when I see the valuations get to a little bit stretched, I'd probably sell. That's what I do with sort of those type of companies. Now, the low quality companies, I'd put HMC, 360, NextDC, and Webster. I just trade these companies. At this point in time, not much happening with any of this, although Webster has the best looking chart. NextDC share price has dropped, and HMC has dropped a lot. And I suppose there is an argument that the negative sentiment in that space has driven the share price down to a level where even though they are not high quality companies, there might be some value, but it's really hard to value those sort of companies, really hard. So you're really relying on sentiment shifting for those two companies. And Domino's Pizza, this is probably the most interesting one. And I think this one comes back to what you think, whether you think the company can turn things around. And if they can, it could be a really attractive buy. It could be. Okay, that's all I have for this article reaction, looking at the 10 best shares to buy today, not today because the market is closed, in Australia. 53 minutes, so I will do some timestamps, I think. If you have any questions, any thoughts, leave those in the comment section of this video. Otherwise, I'm not a financial advisor. If you need financial advice, make sure you seek out someone who's qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.